Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please take your seats. Our program will begin now.
Good morning, everyone, and welcome to Bloomberg's The Future Investor Tech-Powered Portfolios. It is such a pleasure to see a full room this morning, and whether you are joining us in person here in Chicago or virtually from all over the country and the world, we are so pleased to be with you. Many of the challenges that dominated last year show no signs of letting up this year in 2023. We are talking about market volatility, higher interest rates, inflation, geopolitical conflict, labor challenges and shortages. All of these remain at the forefront. For the seasoned investor, experience really helps in challenging times. But for younger participants, this is probably their first market downturn and a pretty tough challenge. Coming up this morning, we will be joined by economic experts and experienced investors who will offer guidance and perspective for investors of all ages. Some of the issues that we will tackle in very efficient and short order will be how the next generation will harness technology to glean data and make smarter decisions. How can investors of all ages reach the common goal of good returns through long-term growth? Before we get started, just a few announcements to help us through the event. First and foremost, we want to thank our presenting U.S. sponsor, Invesco QQQ. You will have the chance to hear from them in just a little while. For our virtual attendees, if you experience any issues with audio or video quality, try doing the old-fashioned thing first. Just refresh your browser. You can also use that chat box on the bottom right-hand corner of your screen for support at any time. We are talking about the new investors, so we want to be current with them, and we'd love for you to engage with us on social media. Please use the hashtag #TheFutureInvestor, and you can also use that hashtag to follow along the highlights of this program. And we will also be sharing highlights and content through our handle @Bloomberg Live. Please make sure you tag us because we'd like to know who we are engaged with. You can also ask questions at any time from our panelists. Just scan this QR code, and we will be flashing it occasionally up on the screen. And you can also find that hashtag at your tables. And again, please feel free to ask whatever you want, what's on your mind. You have the benefit of having some pretty amazing experts with us this morning. So with all that said, let's get started. Please join me in giving a very warm welcome to Mel Hightower, Head of Multicultural Strategic Client Segments for UBS, Angela Miller-May, Chief Investment Officer for the Illinois Municipal Retirement Fund, and Sean Cruz, Derivative Strategy Director for TD Ameritrade. They will be in conversation with Isis Almeida, the Bureau Chief for Bloomberg in Chicago.
Thank you all for being here. Whether it's meme stocks, cryptocurrencies, or something as simple as having and managing their own investment wallets, we know that Gen Z and millennial investors are shaping the way that we think of finance. They consume information in a different way. In many cases, they opt out of a pension, and they no longer rely solely on their brokers to make investment decisions. But how has that changed the way our industry professionals do business, the way they communicate, and the role technology has played in all of it? And this is what we're going to talk about here. So if we look back at the past 10 years, I wanted to know how your job has changed on a day-to-day. What have you done differently? What do millennials and Gen Z want? How does that change the way you think about your job and how technology has played a role? Maybe we can start with Mel, or?
Sure. And thanks so much. I'm so excited to be here. I think one of the main things that we've seen in terms of how my job has changed is really understanding the mindset of the investor. So gone are the days where someone would just sort of let you run with a portfolio and turnkey. So we're seeing investors that really want to be more engaged as part of the investment choices that they make. We're seeing investors who want to be educated alongside you as you are implementing solutions on their behalf. And I think one of the other things that we've seen is the advent of technology. And I just think of meme stocks, which my nieces were a part of, where they're calling me up and my brother called me and said, what is happening in their accounts, thinking that they had done something wrong, but instead they had been following on discussion forums and really coalescing that sort of community power and all driving towards one investment. So what you see is the advent of technology really changing how people are gathering information and executing.
Sean?
I think the biggest thing we've seen is just how we interact with our clients, and also technology has enabled us to have, I think, a lot more just diverse discussions with them. So it can be on education, it can be on retirement planning, it can involve quite a few different products, and also the mediums that we're interacting with them. Right now, the growth in mobile is something that has been incredible over the past 10 years, where we went from low single digits of our client trading activity and logins coming in mobile, and now on some days it's over half. And when you think of research tools, charts, trading capabilities, whatever that might be, when you're going from a desktop platform with the power of an actual computer behind it to now it's limited by what's on your phone bandwidth, it was almost impossible to think of having some of the tools that we have at clients' fingertips now available. If you would have told me some of the features we have, not just in our platforms, but even in our competitors, it said that was going to be there back in 2012, 2013, I would have had a significant amount of doubt. And the other thing is clients coming in, and you think of clients, the level of sophistication they're coming in with. There used to be a pretty predictable continuum. You come in because you're interested in buying a single stock or you're interested in an ETF, and then you slowly over the years might become more comfortable doing something like a covered call or a buy right strategy. That was pretty standard, and we can plan for that pathway as they explore more advanced products. And now clients are coming in and they want to go right into options. They want to get right into trading. And for us, the challenge is how we make sure they come on board, they can participate in the way they want to, but we try and get successful outcomes, more sustainable clients. That's something that was already evolving. And then when you think of what happened with the pandemic in 2020, like so many other businesses, it jumped us 5 years into the future, I think, in terms of just the sheer amount of clients that were coming on board. So for us, the challenge coming out now is keeping them engaged as the momentum trades of just go out there, buy calls, ride the market higher. That really isn't a phenomenon anymore, but we're seeing them remain engaged. And for us, it's more continuing with education and I think getting them to think more holistically about their financial situation.
Angela?
Well, as a CIO of a public pension plan, my day-to-day job has not really changed. I'm still a strategic investor. I still have a long-term horizon. What has changed is the way we implement our strategies, we implement our policies, the fact that we have so much data to research, and the way we source our data, and the tools that we use. And I think these changes have been driven by really just a need for more technology solutions to really analyze the data that we're trying to absorb. And also the acceleration of technology, brought on by COVID that we've all experienced. And lastly, the need for technology because of the macroeconomic changes and challenges that we're facing today. Excel, spreadsheets, and Word documents really don't work for the millennials that I manage, so we've had to really transition to more software technology to really synthesize that data and transform it into usable information that we can use to make decisions. From a different aspect, when we think about the members that will service in the future, those millennials, those Gen Zs, even that alpha generation, they are no longer going to want to pick up a phone and call the pension plan. They're no longer going to want to meet with someone in person. So we have to think about how do we restructure, how do we rethink public pension plans so that we can service them into the future. We think about self-service, technology, virtual meetings, electronic documents, and I think right now we're all many pension plans are modernizing their solutions and their technology to kind of meet those needs down the road.
And Angela, talk us through the interest in pension plans. You know that a lot of young investors maybe aren't as attracted to pension plans. They want to manage their own wallets. They want to invest in riskier assets. What's your experience been?
Well, managing a younger generation and also having two Gen Zs at home, I think back to the baby boomers and the way they saved, the way they invested, whether it was, savings, government savings bonds, whether they were part of, a pension, part of an employer stock purchase program. All of these things are unfamiliar to the new investor. And so, they had benefits, and they were generous benefits, and they took advantage of everything that their employers had to offer. And normally they stayed with a company for 25 plus years. And now if we fast forward to today, pension benefits are not what they used to be. It requires the new investor to really look at the stock market and different ways to invest. And thinking about a public pension plan is like an afterthought to them because there's more years that they have to be vested. The benefits are lessened, and you have to work more years than they even could fathom staying with an employer. So it's really, on the back burner, it is a benefit, of course, but secondary to them wanting larger salaries and being able to invest personally and aggressively in the stock market at a faster pace. And so I'm seeing more of that, and it's just kind of a move away. Corporate pensions have kind of gone away, so it is something that they think is great because their parents have pensions and they no longer have to think about how to secure income to take care of that generation. But the way they're investing is much different than how other generations have invested.
Right, and we talked a little bit about communications and the way we communicate. Is more information equals to better information? Is it really helping the generation make these decisions? And Sean, there's a question from you from the audience wanting to know whether you have restrictions and what's your guidelines for communicating via mobile.
No, if you think about it, if we send you an email, electronic communication, and you check it on your phone, technically that's considered a mobile communication. We try and utilize almost any channel that we can in communicating with clients, and that's not just for any sort of legal communications, but clients can access service. We invest quite a bit in our service capabilities, and we don't want the only way you can interact with our service to be by picking up the phone. We want you to be able to chat in on your mobile or whatever that might be. And that's also something that is an interesting turn where we actually see a lot of our more sophisticated clients comfortable going through mobile, but you've got to make sure they don't get the sense there was some bot that's just giving you canned answers. I think that's something that's an interesting development as well, because it used to be if you had 1 million clients, you had to have enough people on the phone on a busy day to pick that up. Being able to do things through chat and other channels certainly helps. And I think it's not just support that we're thinking of or delivery of legal documents, but also education now. We've invested quite a bit in education as well, to be able to have our clients learn, become more informed investors through any medium they want.
And Mel, is more information better information, or are they making better decisions? What are your experience?
Not necessarily. I think it depends on the source. I mean, finance TikTok has become all of the rage, and having been on there and seen some of the advice, definitely source of information is something that people should take into account. So I don't necessarily think more information is better, but I also think that attention spans are getting shorter. So gone are the days that you could do sort of an hour-long session. People are looking for information in snippets, and so that's changed the way that we've rolled out communications. Like, we're giving highlights in no longer than a minute or two, and really giving people the takeaways and allowing them to have a journey through the information in a way that suits them. So we're finding that, although finance TikTok, be that what it may, there's some great advice on there, there's some not so great advice on there, but we are really looking at exploring some of those mediums and seeing if those are areas that we want to take a look at.
And when you think about that, is financial advice dead?
I don't think so. I think that the old method of delivering it is waning. Where you would make an appointment and you would go see someone. I think what we're finding now and what the pandemic has really accelerated for us is that people are quite comfortable meeting with advisors over Zoom. People are quite comfortable getting messages sent to them through mobile. That is all something, and people are quite comfortable in entering a Clubhouse chat and having a conversation with advisors. All of the mediums are on the table.
Right. If I could bring this conversation a little bit back to what's going on right now, what we're reading in the news, we're looking at, a war in Ukraine, and a lot of these investors have never seen a boots on the ground war. They've never seen inflation this high. And remember, last time inflation was this high was 40 years ago. So a lot of these young investors weren't even alive for it. When you think about that, how they've also never seen a Fed that's been this aggressive with monetary policy. How has that affected their decision making? They were all into meme stocks and crypto. Are they getting more conservative now?
Yeah, I think I'll take that. I think what you're seeing is a lot of millennial investors start turning into longer-term investors. What we've seen up until recently, a lot of folks have been chasing short-term gains. And what all of the advent of these, whether it's US-China tensions or the war in Ukraine or a lot of the monetary policy decisions, is that it forces younger investors to start looking at that longer-term horizon. And I think that, and I can talk a little bit later about how we see the advent of sustainability kind of come back to the forefront when that happens.
Sean?
Yeah, I think one thing that's been really interesting just in terms of client interaction. So one, when we look at some of the moderation in trading activity, the biggest drop, if you look at it from groups, it's people that opened their accounts in 2020 or 2021. Now, they're not trading as actively, but they're not disengaging. They're not saying, I'm pulling my money out and going elsewhere, wherever that might be. They're doing exactly what you said. They're starting to think more holistically around the macro environment. Some of them are still sitting on some good profits that they did make over the 2020, 2021 period. And they're now looking for, I think, a little bit more of a longer term investment. Another thing we're seeing is a lot of activity moving away from single stock type names, and they're going in towards exchange traded products, things that tie in a lot more to the macro themes that they're seeing. And I think inflation's a great example because you actually, I think traditionally you would think, I think crude oil is going higher, I'm gonna buy ExxonMobil or one of the energy companies. But what product development proliferation has done is there's actually a lot of products of, if you wanna do something where you are now have upside exposure to crude oil, there is something where you can get that direct exposure. You don't have to try and go through Exxon and hope they don't have a fire or an outage or an oil spill. That's a huge, I think, difference that we've seen, and that has actually really taken shape over the past year, and you see it show up in volumes across the industry. So I don't think it's just our clients. I think it's retail investors across the board are starting to shift from single name stocks into more of those vehicles they can play macro themes on.
Yeah, I think over the last 3 years, there has been a transition for younger investors, as well for those of us who haven't been in the industry for 30, 40 years. The inflation is new, and and we're thinking about it differently. We knew at some point, that there was going to be market corrections, there was going to be volatility, there was going to be inflation. It took us 3 years to kind of round that corner and actually see it. And now, one of the biggest challenges for a large institution like IMRF is that, the breakdown of diversification benefits between stocks and bonds. And that has been something that has driven our decisions, as well as younger investors. No matter the generation, we all knew that we had to rebalance our asset allocation. We had to rebalance. We had to look beyond stocks, to look at other strategies to really meet our investment objectives. And so that's been really a part of it. Younger investors just have come along. They understand that this is a way that public pension plans invest. They are thinking more long term. They are thinking about investing, spending, and debt differently than they were before.
And there's no way we could not talk about FTX here, right? So we're talking about young investors. We need to talk crypto. After the collapse of FTX, are you seeing their attitudes towards crypto change? And can you talk a little bit about what's your organization approach to crypto? Can you touch it? Can you not? And when you think about, I'll bring in a question from the audience here too. They're asking about what's the mentality between wanting that short-term gain that we've seen, in assets like crypto?
Well, we've been open to educating ourselves more about cryptocurrency and blockchain. But, as a public pension plan, we do not invest in cryptocurrency directly. We do have some venture capital managers that have some limited exposure to it. There was some exposure to FTX and others, but very limited. We would definitely not invest in a manager that solely invests in cryptocurrency. Now the millennials on staff, definitely interested in crypto, definitely interested in blockchain. And we've, tried to educate ourselves around how it's not a good fit. Normally, we don't invest in anything that we don't have a grasp, understanding of, or that is not regulated. And that's a part of most pension funds investments. There has to be regulation. And so I think that, it is an industry that's going to be around because there's going to be a demand for it. I don't think that millennials have turned their backs on it, but they're definitely, after FTX, asking important questions around due diligence, around really regulations, and how do they protect their money.
Sean?
Yeah, I think that if you think about the big thing with FTX, it wasn't necessarily the crash in the value of crypto, which when you're investing in something, that's usually the very front of your mind is this going to go up or is it going to go to zero? You had already seen Bitcoin correct from 60,000 down to 20,000, in some cases a little bit lower, and that occurred over the past year. The problem with FTX was a little bit more of transparency that you get in our markets. You don't get that if it's a company in the Bahamas. You don't know what the rules of the game are that they're playing by. It makes it a lot more difficult. And I think for a lesson learned, I think if you just want to say, luckily, this wasn't something widespread. So it wasn't able to become systemic and really take down the financial system in any meaningful way. But if you think about it, if we had mandates from pension funds where they were putting mandated in their investment policy statements to put money in there, you could have had crypto spread around the financial system and people could have been in some trouble. So I think moving forward, and what I think this does mean for the crypto space is there's going to be almost an institutional due diligence mentality out of individual investors now. If you are gonna go out there and try and market crypto, offer crypto, you better have a pretty deep FAQ behind it and be ready to answer some very pointed questions. And I think that would be a good sign to hear coming from individual investors, that they get it's not just about what can go up tomorrow. They're thinking more holistically around just the general safety of their investments.
And Mel, what are your thoughts? Is crypto dead?
Oh, absolutely not. But I think to what the other panelists have shared, I think that there's been a sobering effect with what's happened with FTX. And I think to your original question, which was why millennial investors have been so short-term focused. I mean, when you think about it, right, look at what's happened with the S&P 500 since 2008, right? It's been up 262%. These investors have never known a down market. Things only go up, really fueled by the advent and the quick turnarounds we've seen in tech stocks, where you've had just enormous pops in valuation in short periods of time. So it sort of has been encouraging that short range focus and that short range mentality. But, those things tend to be waning. I mean, I think US stocks right now are underperforming the rest of the world by 2%. So I think it's forcing that reckoning that eventually happens where people are starting to slow down and take a look at it more long term.
And if we can, get your crystal balls out, look into the future, what trends are we seeing now that you expect to persist? Mel?
Well, I think in terms of, AI is one of the trends that I see that will persist, not only on the financial industry side, where they're using AI right now to really cause more efficiencies, even in how they're onboarding clients and how they're processing lending applications and whatnot, but also on the investor side. Right, AI is super efficient in the fact that it takes the emotion out of decisions. It's going to be much better than an individual at that. The downside risk, though, is that it's only as good as the data that you put in it. And so I think you'll start to see more happen in the AI space and even beyond the use of robo-advisor and robo-advising platforms. But I think what you see is millennial investors have said, and we've surveyed them, they like the transparency that AI offers when making investment decisions. And so you'll see more of that in the coming years, I believe.
Sean?
I think from an investor standpoint, there is going to be a lot more of a holistic focus on the ecosystem around any theme. And so I think electric vehicles is probably a good one. And that is people aren't just trying to find the next company that's got the coolest car, the coolest gadgets or the longest distance. They're actually really starting to think more holistically around, they're going to need chips. So I start looking at semiconductors. These batteries use a lot of rare materials. How do I find out what those materials are? And then how maybe do I invest in that huge build in demand that's not just coming from Tesla, now it's coming from GM, Ford, Volvo, all the major car companies. They understand that now. And I think the challenge is going to be, how do you invest in those? Because I think if you ask someone, how would you go invest in platinum or palladium or whatever that might be right now, they wouldn't really have a quick, direct answer. They probably have to do a little bit of searching. But I do think it's not going to be just focused on the front end, coolest tech. It is going to be, I think, a little bit more of a balancing act between actual physical commodity investment and then still having some exposure to those front end platforms and services that they're going to be offered. So I think it'll be more diversified than just let's pile into every up and coming tech company we can.
So I think we talked a lot, about factors that involve ESG. Angela, maybe you can talk a little bit about how you're incorporating ESG into your business and how important it is for young investors.
We've really taken ESG and really implemented it into our processes. We look at ESG more as a tool, an evaluation tool of the asset managers that we hire to really understand where they can mitigate risk and create value in their strategies. So it is a part of our processes. It runs through every asset class. We ask those questions of every manager, and it allows us to really take a deeper look into how the environment, how social and how governance really can drive a strategy. We focused more on the S here in Illinois because we do encourage DEI, diversity, equity, and inclusion. We look across managers and we try to encourage the access to capital for minorities and women-owned firms. So we spend a lot of time on that S part of ESG.
And how are you looking into, greenwashing and how do you avoid that? What sort of precautions are you taking, and what do you see as the future of ESG with a lot of states now trying to ban ESG investing? Maybe Mel, you can take that one.
Yeah, so I think that what's happening now is sort of the emphasis on reporting, right? You used to be able to get away with sort of a vague promise and then some sort of environmental commitment, but gone are those days. And especially now that the accounting firms have really standardized how companies are being able to report on their ESG standards. So I think you're going to see much more emphasis on the data piece of it. And it's important because when we look at what investors are looking for, millennials are the one population that is really doubling down on the sustainability commitment. What our studies show is that 6 in 10 of them are involved in sustainability through their personal, across the board, personal consumption, philanthropy, and their portfolios. And 40% of those millennials have a 50% allocation or higher to ESG integrated products. So it's incredibly important for us. And I think the future of ESG is going to really sort of move along those lines and taking a more holistic not only looking at reporting, but really demanding that CEO pay potentially be linked to some of these ESG standards, really taking a look at something we call inclusive investing, which is what Angela talked about. How can you change the ecosystem of how capital flows throughout the system by putting it in the hands of more diverse capital allocators? That's something that we're seeing more and more appeal to millennials. And so I think that they're going to be looking for measurement around those commitments in an attempt to avoid greenwashing.
And if we think about technology and the next 10 years, what technologies you see prevailing, which ones you see maybe coming up that will shape the world of finance? Sean, you want to take that one?
I certainly think the move to mobile, that is something that will continue, and the big driver behind that will be the capabilities of what we can actually put in there from a feature standpoint. And it's going to have to be, I think, a lot more rich. It's not just the next coolest trading feature. People are going to want to holistically be able to manage all of their investments. So if they have some money with a pension fund, they've got some money in some other retirement account, and then they have their active trading portfolio. That is another thing we've actually seen is it's a lot more of a diversified need. It's not just everyone comes and fits into a nice bucket. So being able to develop the tools for that is going to be a big challenge for us because people want to do things in mobile. It's just the medium we're going to have to learn to deal with, and I see that continuing here moving forward.
And how does that play out in a pension fund environment?
Yeah, I would add that over the next 10 years and even now, risk management is at the forefront of our investing, especially with the environment that we're in now. And a lot of the products, be it from Bloomberg or others, we're looking at to really just analyze the data. I don't think the fire hydrant of data is going to turn off. We're going to consistently be able to research and analyze and really to make really good decisions on the strategies that we are investing in across the portfolio.
And Mel?
Sure, I think that, in terms of technology, one of the things that we're going to see, and we've talked about the investment piece, but I think the interaction piece is going to change too. So at the end of the day, what we're learning is that investors want to talk to other investors. And so what you'll start seeing is technologies that enable that to happen. So a lot of the things that advisory firms are looking at now is how do we move the conversations that are happening on TikTok, on Clubhouse, on Facebook forums, how do we bring them in-house and allow investors to talk to one another and also add our own views to that. So we are trial ballooning some products that have been, and actually in Asia, we tested a community-based platform that's done incredibly well for having investors talk to other investors and community building around particular topics such as ESG investing or philanthropy or even art. And we think that that's going to be the wave of the future and how technology will change.
I really appreciate all the insights, having you all here. Thank you so much. This was great.
Thank you.
Thank you.
Thank you.
Let's continue the forward-looking thinking with our Invesco QQQ sponsor spotlight. Please welcome a panel, a conversation on timely innovation with Paul Schroeder, QQQ Equity Product Strategist with Invesco, and Michelle Lin, Global Head of Data Science and Insights with Bloomberg Media.
Hi there.
Hello.
As Janet said, I'm Michelle Lin, Global Head of Data Science and Insight for the Bloomberg Media Organization, and I'm joined by Paul Schroeder, who is the QQQ Equity Product Strategist for the Invesco QQQ Sponsorship Spotlight on Timely Innovation. Welcome, Paul. It's so great for you to be here with us. Should we dive right in?
Sure.
All right, so the first question, just as a reminder for everyone, can you tell everyone what QQQ is?
Sure. So QQQ is the 5th largest and the 2nd most traded ETF in the world, and it tracks the NASDAQ 100 index, which is one of the most widely recognized indexes in the world. Now, the NASDAQ 100 invests in the 100 largest non-financial companies that are listed on the NASDAQ Stock Exchange. And really what we've seen through the years is that QQQ has become synonymous with the large cap growth category. We see QQQ comprise about 27% of all large cap growth ETF assets now, and really I think that can be attributed to the fantastic job that NASDAQ has done with attracting new technologically focused companies to list on their exchange.
So I know this panel is also called Timely Innovation. I know QQQ is associated with innovation. How do you actually define it?
Sure. So as what we've seen through the past few years, innovation has been a very widely used term, not just within our industry, but across the board. You know, we like to say that innovation, the actual term, doesn't appear on a financial statement. So how do you really define it, which is what I think is key to when you're focusing on investing in innovation. So really, we look at 2 key metrics when we define innovation. The first would be research and development spend. Obviously, companies that are spending more and focusing on research to develop new products help the companies remain relevant today. But research and development is also a longer-term commitment to their business. It's something that the research and development spend doesn't show up on the bottom line necessarily this quarter or the next quarter. It's a commitment to keep them relevant for years to come. The second key factor that we look at would be patent activity. And really what we want to see next after large research and development spend is that a company is able to patent that technology to be able to gain some sort of asset for their balance sheet, along with being able to monetize that research and development going forward. And what we've seen from NASDAQ 100 QQQ companies is that we've seen greater patent activity within those companies within key technologies that are relevant not only today, but also should be relevant for years to come.
And so what does that all mean for the investor?
Sure. So it really means 2 things. The first thing that I think it really means, and I think is very relevant to younger investors, is that it gives you access to these companies that are the leaders within their industry when it comes to innovation and on the leading edge of changing where their industry is necessarily may necessarily be going. Secondly, what I would say, and more importantly, is that investors really invest in companies seeking fundamental growth. You know, at the end of the day, we talk about research and development and patents, but if they're not growing their fundamentals, then you're not going to see the stock price rise as much as you would like probably. So what we've seen from NASDAQ 100 companies, QQQ companies, is that their fundamentals have outpaced that of the S&P 500 and the Russell 1000 growth within key areas such as earnings, revenue, and dividends.
Can you just talk for a minute about Invesco's commitment to the individual investor?
Sure. So Invesco is always focused on giving access to different investments that might not necessarily have been available to the individual investor in years past. I think a really key example of this is the ETF. You know, ETFs have done a fantastic job, and as we all know, have really democratized investing into more complex strategies that might not have been available to individual investors in the past. What Invesco has also been doing is we've also been making a commitment on financial education, especially for younger investors, key things that will help investors along their financial journey.
Okay. Well, Paul, thank you so much for sharing your insights on timely innovation as part of the Invesco's QQQ Sponsor Spotlight. Really appreciate your time.
Thank you very much.
Thank you, Paul and Michelle. Moving right along, our next conversation is BI Presents, Trading with New Technologies. Please welcome Ed Tilley, Chairman and CEO, CBOE Global Markets, in conversation with Anurag Rana, Senior Technology Analyst with Bloomberg Intelligence.
Hello, everybody. Hi, Ed. Thanks for being here. My name is Anurag Rana. I'm a technology analyst with BI, and always keen on, trying to figure out what's happening in the tech landscape. And today, it'll be fun to understand with the markets moving all over, where do we go from here? So let's start with the current trading environment. Like, where are we now? I mean, we've seen so much of movement over the last few years. How do you see the current space?
Well, I think today's investor obviously has more uncertainty in front of them than I can remember. We were in the green room preparing, and we're looking at the market, and we're like, gosh, the SPOOs have only moved 20. And in my day, when I started investing, that would have been a year's move, or certainly a half a year's move, and we don't think much of it. And processing that amount of uncertainty and volatility, it's the tools in the background, the preparation that today's investor needs to be up on.
So I remember, the days of 2008, 9, 10, when the market volatility was so high. Citigroup was up 20, 30% down in a day sometimes. Then a few years later, we, saw the pandemic, which had unbelievable volatility again. How do you help your clients navigate this new normal of increased volatility?
I think it's in preparation and education, and we're really trying to teach, after 50 years of running an exchange, and a global exchange now, is really the tools that are out there at every investor's fingertips are really in derivatives, and the ability to predict and to plan for any eventuality, any outcome, changing the P&L from a 45-degree line of the derivatives and outcome-based, or defining the outcome of investment, is really quite easy. And in this environment, there is a strategy for every possibility.
So you mentioned derivatives, and I go back again, perhaps during the financial crisis, there was a lot of hue and cry about derivatives and how some of those were written. How's your world change, perhaps either from a technology point of view or maybe even compliance point of view for that particular instrument?
Well, I think the instrument itself is quite simple, but the strategies and the complexity is really investor-driven. And again, it's with preparation. So there's suitability for every investor. There are products, there's packaged products, there's notes and funds, and it looks quite confusing until you take a step back. Every note, every fund has a prospectus. It has a designed outcome. So wrappers work for quite a few. For me, I like to look at my own strategies, and I have a prediction, I have a direction in the market, and using derivatives allows me to, as I say, shape that P&L curve differently.
So this is usually, thought about it for the institutional investor, but, where are we now in terms of the Gen Z getting into investing? How's that different, in your opinion, than what you have seen over the last, let's say, in the previous generations?
Really the access to information. We've seen a trend. I started investing in the late 80s, but the amount of information at your fingertips, and look at where we are right now, the availability from Bloomberg in and of itself as a source of information is second to none. The Gen Z investor has the same information professionals had years ago. It is one source, so I encourage all new investors and Gen Z investors, take in multiple sources of information. Every source is a good source, There's a source of information for trend investing, for long-term investing, for just day trading. And depending on your strategy and direction, each are suitable, but each have valuable information in and of themselves.
So again, I'll go back to the whole meme mania of a few years ago, and perhaps what, from your vantage point, how did it happen? What was the pluses or minuses in your view? And my obvious, one of the things you just mentioned, my biggest objection in some cases was that I couldn't trust the source of information that was coming through. What advice do you give to investors on that? And I'd love to hear your take on it.
Track record. If a meme or your favorite social media outlet for information, the information, if you don't trust it, is still very, very valuable. Fade the information then. It may be right for moments in time. Those are trades, not necessarily investments. So depending on the purpose, that source of information is extremely valuable. And it could be for moments in time. And those are trades, and that's okay. But for long-term investing, I don't think I would necessarily source my long-term strategy from a post that may or may not have at its heart the long-term sustainable investor. And that's okay, but it's still very good information.
I'll portray the same question in a different way. So during the meme mania, there were certain companies, and I won't name them, but if you looked at the business model, it says no sane investor would be, logically putting any money on it, and then, stock kept on going up every few days, and so purely because of a push. As somebody who's so senior in the, the trading area, how do you counter some of that stuff? How do you sell that? Because at the end of the day, people need to have confidence in the market that they are pricing, assets properly. How do you manage the two? What's your thought about both those things?
Yeah, I think there was probably completely overweight in the attention that meme investing got. That is really not the typical investor. And when I say investor, that's really what CBOE, through our 50 years of running 26 markets around the world, that's not where we're focused. Our focus is on sustainable investing. And I only use the meme reference as a point of information. And part of the process of developing what might be a short-term strategy. But for us, we certainly don't encourage chasing trends. Those might be good trades, but that is not an investment. Ours is really out of measured sustainable investing, day in, day out, year in, year out.
So if you look at the technology framework, things have developed so much over the past few years, from cell phone to cloud computing, et cetera. How have trading platforms changed in that framework, and how have they changed based on the different demographics?
I think trading, when growing up and watching the business evolve, the technology where we find ourselves today and running lit, transparent, trusted markets around the globe, it's really table stakes. And I say that from an exchange operator, and most of my fellow exchange operators view that the same way. We need to be a source of certainty. The risk in trading should not be the platform and the exposure that an exchange has. So rather, we just shrug our shoulders as trusted operators saying, you have an expectation, and our job is to deliver the exposure that you all seek and take the exchange out of it. You just have to trust that we are there operating, regulated, and we'll be there the next day.
And you're a global company. How have you seen the differences between different geographies? I'd love to hear some anecdotes as to how trading is different in the U.S. versus Australia versus Europe, or any other market that stands out to you.
The amount of retail accounts are certainly up over the years, and I think the pandemic was a great catalyst there. But the engagement is certainly different by geography. In the U.S. And APAC region, many, many more engaged daily investors and traders. And Europe, not so much. And it is in developing those markets as one of our keys is to make sure that the experience from an investor, no matter the geography or the asset class, needs to be the same. So when we look into new regions, it's how can we replicate the incredible experience a U.S. Investor has in different geographies as we look across the globe.
So emerging markets has always been a big area and discussion point, and China has been off in the last couple of years, but before that, it was the place to be for everybody. How are you navigating that part of the world?
Really, it's any market that is open for competition. What I mean by that is there are incumbent national treasure exchanges around the world. But regulators around the world see that competition from exchange operators brings lower cost and better technology. So we chase those geographies that allow for competition. So APEC in particular, we operate a PTS in Japan, and we are an exchange operator in Australia. Very important for us that those regulators see the benefit of competition on behalf of their customers. Very important for us.
Okay. I'm going to take a couple of questions from the audience. CBOE has been a strong acquirer lately. What does the future look of CBOE look like? More of an exchange or more of a data provider?
Well, data is the data that we have, the exhaust from running an exchange is extremely valuable. In its pure sense, that means in real time, the data from the top of the market, the data from the last trade, the data from the size of the market on the bid-ask is extremely valuable. But what is really important for us is enhancing that data. So we can take that raw data and we can show you risk profile across the globe. That's very, very important as investors have a choice as to where to deploy their capital. So for us, it's not just the pure raw data from running 26 different venues, but what can we do with that data? How do we teach you? How do we give you more information than just the raw data coming off of a trade or coming off of the top of the market?
Fair point. As expectations and access to information evolve, how are you managing new market players? What role should regulation play in this?
Regulation, I think we've learned lessons of late, and it's not new to exchange operators who have been in this business for years, is oversight and regulation is key. Running trusted markets, our partners are regulators in every geography. The trust that comes out of highly regulated, transparent markets, I think we've seen examples of when that's not the case. So for us, again, we just take regulation and oversight as part of the game. In the US, we have two regulators, the SEC and the CFTC, very unusual if we look across the globe. But every one of our markets is regulated, and we embrace and look forward to that regulation because it brings trust to the process.
And then as an exchange operator, how are you combating the increased prevalence of naked short selling, failures to deliver, and the prevalence of synthetic shares?
A great, insightful question. From an exchange operator, that is really the role of your broker-dealer or introducing broker or FCM. We are not in the business of the suitability, whether it's from the short side, the uncovered short, or the hard-to-borrow side. That is really a level removed from us. We don't go direct to customer. Unlike the newest asset class, crypto, we actually rely on our partners to make sure the investments for retail and institution are suitable for their need and purpose, and that includes the points in the question.
So Ed, you had mentioned a few minutes ago in the green room that during the pandemic you bought a lot of companies. You acquired, I think, 8 or 9 companies you mentioned. Would love to learn a little bit more about it as to what was the rationale behind, any one of them, and how do you plan to integrate them to your current offering?
Well, I think the pandemic was just interesting from a process and diligence perspective. We found the tools, like all of you found, we adapted quickly, and we're not going to allow the change in our day-to-day to affect the path and the direction that CBOE set out to do, and that was to build the world's largest network of trusted markets. So again, back to the theme, in geographies and asset classes that were open for competition, we were full throttle, and we did not let the pandemic slow us down. We found very effective ways to run diligence, and we're in the process now of integrating those markets so that we have a common platform across the globe that our customers, they plug into us in London, in New York, Amsterdam, Tokyo, Australia, in Toronto. They're all the same experience that we're building on and migrating the same technology platforms, so that's consistent, it's trusted, it's lit, and it's regulated. And most recently, we're into the crypto space We bought an exchange here in Chicago called ErisX, which is now CBOE Digital. And we're extending the same experience, the same trust to the crypto and tokenized exposure.
Crypto, let's talk about crypto.
We made it a long time without bringing it up.
I was waiting for the last 5 minutes. And what's your take on it? I mean, I'm very curious about it, going back to, all the way from the concept of crypto to the ability for people to, trade it with trust. I mean, the headlines we have seen over the last couple of months is just, probably the tip of the iceberg. We're going to probably see more of that. For me, just teach us what happened in this particular case, or your take on this entire concept.
Well, I think the observations, I don't have any insight that's different than perhaps what you and what Bloomberg would cover, or the opinions that you've heard. But from an exchange operator's perspective, it's head scratching to us that the conflicts that exist, not just day to day with customer funds, but the lack of governance and oversight is unthinkable. First in a public company that operates globally, but from an exchange operator who is highly regulated and views regulation as partnership, the concepts and the conflicts are unthinkable. So moving into the space, and we were actually well down the road long before the problems that are in the headlines today with crypto and tokenized exposure of ErisX onboarding. And it just, for us, the model didn't change. We wanted to extend into the new asset class the same trust so that you can, if you want exposure of crypto, the risk is not in the operator. Again, back to the theme. The risk should be in your perception of being long or short a given token, not whether or not CBOE is going to open up its digital platform the next day, or if your funds were misused. So our model relies very much on our trusted partners and introducing brokers and FCMs. It's very friendly that way. And the direct-to-customer, while an interesting concept, the amount of risk, oversight, and value add from the traditional approach is still what CBOE aims to deliver for customers.
See, while I don't understand crypto as much, but I have some idea about blockchain.
Yeah.
How are you embedding that in your operations, or it's already there? Any comments on that?
So from an exchange operator, the speed of transaction right now, the DLT would be challenged to deliver, but there's post-trade technology that might be more suitable in a shorter time frame. But we are very much listen to our customers, and our customers, not retail, institutional liquidity providers, who are not asking us to pivot from the technology that they're used to today onto DLT for day-to-day transactions. So we'll listen, we'll learn, and as technology cuts down that latency, that might be a conversation for the future.
I'm just curious, because I've always thought a good database should do exactly what blockchain would take care of. Have you ever done any back testing as to would it save you some error rates, some costs if you ever go down that rate, or the way it works is good both for accuracy and speed?
Right now it's speed. So the latency would just not be able to support the amount of transactions and processing in today's derivatives world, which is multiples of the equity space. So technology will catch up. We know that. Technology has proven itself to catch up. So it is definitely a question for the future.
Another question from the audience. Are you planning to release more crypto trading products?
We are. We're very mindful in the U.S. Of the debate between the CFTC, the SEC, and now the Hill on oversight. And in particular, whether some tokens represent securities exposure or not. And as that debate unfolds, our goal is to receive CFTC approval for margin futures. We have state-by-state approval to run an exchange in the U.S., and we will be taking this slowly as the SEC and the CFTC debate jurisdictional oversight. But our goal is, of course, to offer more and more exposures than the current 5 tokens that we do today.
Fair point. Another question, how are you shifting your operations to the cloud? What are the benefits to your customers?
So for right now, it's data. So our data and source to the cloud is really on distribution and being able to access data anywhere in the world. So our first big move on behalf of our customers was really in the data space. And we do want to make sure that anyone has access to CBOE's data. As I say, that is the first step. That is how we backtest. That's how you all learn. That's how we are able to enhance data. So the first move was with data to the cloud.
Fair. Do you foresee the development of a blockchain-based carbon credits exchange? And for people like me who don't know what a carbon credit is, it's the offset environmental impact by making environmental positive into a product.
Yeah, I don't think I'd answer as specific as just as an offset for carbon credits. Rather, the tokenization of things that we know and making those tokens and allowing the boundaries that we are currently forced with delivery, for example, boundary lists. I think tokenization and moving assets onto token will be a trend over the next years. So not just credits, but I think much more broadly than that.
Great. We are out of time. Thank you so much, Ed, and it was fun chatting with you.
It's awesome. Thanks.
Thank you, Ed and Anurag, and bravo to this audience in this room and virtually for some pretty brilliant questions. We promised we would be very efficient with your time, and it is now my pleasure to lead our final panel of the day, going long on emerging growth trends. I will be speaking with Gene Munster, co-founder and managing partner of Deepwater Asset Management, Michael O'Keefe, chief investment officer with Stifel, and Yelena Malayev, economist with KPMG. All right, we want to look forward and how we can be better investors of all ages. Michael, let's begin with you. Stifel is the 7th largest full-service investment firm. Tell us a little bit about your clients, your investors, and are you seeing younger investors coming into the fold?
Sure. So Stifel, basically think of Stifel as a middle firm, meaning not as big as the largest, larger than boutiques. So we have kind of the classic set of clients, both institutional and wealth. I would say on the wealth side, a good amount of our sort of younger investor is really next generation. Could be second generation, third generation in a family that we're serving, but we're definitely seeing it.
Yeah, and we'll be talking about that wealth transfer in a moment. Yelena, I love speaking with economists. We put you on the spot. I have to ask you, is this, given all of the challenges going on right now, has this been one of the most challenging forecasting times for you as an economist?
Definitely, 100%. I mean, not just this year, last year, even early 2020 when this, the COVID outbreak was first just centered in China, and we were assuming maybe we'll shave 1 percentage point off of US growth. How silly were we to assume those things? So this has been a very humbling experience for forecasters, definitely.
Gene, Deepwater Asset Management, which has a new name as of just a few days ago, presents itself as a tech-focused investment firm. Explain what that means.
So we're investing in private and public companies. That's different than where we started, which was only private. And we're focused on growth that's enabled by tech. So all the companies that we invest in, we have a belief that they're going to have growth that's persistently higher than most investors expect.
Michael, you bring up a lot of investment themes that you're looking at right now, and you call it the fourth industrial revolution. That's a big concept. Explain what that means and some of the things that you are looking at.
Sure. Well, and just to be clear, that's a World Economic Forum concept. There's a lot of research going on there. Really, I think some of it gets discussed at Davos, for example. But we've sort of embraced it for the idea that technology and the advances in technology are really accelerating both the speed and scale of change. And when it comes to investing, of course, we go back and look back, you could say, hey, let's invest in those tech companies that are developing the technology. But as we look forward, the themes are evolving to digitalization. How can traditional businesses take advantage of these specific opportunities?
Gene, I have to ask you about this, and anyone feel free to jump in. We're bringing up technology, but it's been challenging times for technology lately. You boldly make a lot of predictions on your website. I think it's fantastic, and you give yourself report card,
Yeah,
basically.
thumbs up and thumbs down.
Yes, and it's bold, and it's actually great. So there are a couple of things that you are predicting. You are predicting that, first of all, there are going to be fewer unicorns this year, and that would imply that there are fewer investment opportunities when it comes to tech. Do you want to dive into that a little bit more?
Fewer opportunities, I think, in investing, or I think the opportunities are presenting themselves as these once unicorns decrease in value. And we're probably going to see a 50% haircut. I don't remember the numbers off the top of my head. It's something, there's like 700 unicorns. It probably goes down to 300, something like that. It's going to be a measurable drop. There's going to be opportunities there ultimately to own some of those good companies. That's part of the reason too why we want to be both private and public, because we think some of the best opportunities are in the public markets today.
Yeah, and you do both. You do a hybrid now as well in some of your funds. We have a great question for Yelena coming in. When you're researching, do you prefer more lagging or leading indicators? And which indicators do you most rely on?
Thank you. Yeah, thank you to the audience member. That's an excellent question. I think the first thing we need to think about is what are we trying to answer? Are we trying to figure out what's going to happen, or are we trying to figure out what has happened? So the lagging indicators are good to understand what has happened, especially as they come in more revised, especially thinking about the unemployment report, the BLS jobs numbers. But when it comes to leading indicators, those are my favorite. And I would say I'm very much interested in sentiment from home builders, sentiment from consumers, sentiment from business people, because that helps understand where decisions are going, what we're going to be thinking about when we think about hiring decisions, spending decisions, and then when it comes to the housing market, which is one of my focuses, what is the housing construction going to look like over the next year or two, because that tends to lead the overall economy. When you buy a house, you need to buy things to fill it with. Consumption is 70% of our economy, so those things really rely on each other.
What are they saying? What are the leading indicators saying?
I was just going to ask
construction?
that. Tell us more about what you
Thank
see
you.
in the housing market.
So it's actually quite interesting. Just this month, we received the National Association of Home Builders, Single-Family Builders sentiment, and even though it's still considered in contractionary territory, anything below 50 is contractionary, it had a small tick up for the first time since August, so however many months that is. And so yes, housing is still inside that downturn, very cyclical indicator, very responsive to high interest rates. But on the upside, when we start seeing rates come down, mortgage rates come down, the demand is there. It's going to be one of the first sectors to come out of that negative area.
I'm excited for, I think there's going to be some money made and invest in some of these real estate tech companies too, because everybody, I don't like this word, the word is banned in our home, hate, but there's a lot of people that hate real estate stocks right now, and I think they're going to make a run, as you're talking about. We're owners, by the way, of Zillow, so fair disclosure.
Oh, okay. Thank you for that disclosure. Well, talking about housing, a lot of the issues are tied to, again, the generations. Some saying the housing stock is in part because of the older generation holding on to their homes. Maybe this is a good time to bring up that wealth transfer in the generations, Michael, because a lot of young investors are going to start investing whether they like it or not, because they are going to get one of the largest percentage wealth transfers ever, with the baby boomers now transferring to the millennials. And that, of course, must affect who is starting to invest with you.
Yeah, I mean, I think to me what's interesting about that transfer is when we take a step back and say, okay, it's going to feel dramatic over, I don't know, 10, 15 years. That seems intense. In practice, it happens gradually, right? And so what's happening is we're serving clients in the way we traditionally would. A next generation individual comes into the mix. Maybe there's a trust set up for them or another account set up for them, and all of a sudden we're engaging more on their terms. When we were prepping for this, the question came up about asset allocation and sectors, and I said that next generation really doesn't use that nomenclature. They're very much, in my view, bottom up. They're looking for themes that they can get behind, that they're interested in. I think given what we've been through with the great financial crisis and even the pandemic and the market's reaction, they're actually a little bit risk averse. And so a lot of what we do, it sounds sort of straightforward, is we're on one hand coaching them on diversification, kind of classic investing. And in today's world, of course, two examples where there's opportunity, as boring as it is, fixed income, non-US stocks, two things that have been out of favor. But we frame it and really look for opportunities that are more bottom up and relate to the themes they're invested in or interested in.
great question, a lot of great questions from the audience. For public sector investments, we are living through a massive government push towards national clean energy development, the Inflation Reduction Act. How are you adding this into your evaluation? And maybe I will ask you first, because you do both public and private investments as well. And with that, sorry to make this an extra complex question.
Okay.
Are the younger investors demanding more as far as the social impact issues when they say they want to invest?
I don't know. On the second one, my sense is yes, but I don't know for sure. On the clean energy piece, there's still this challenge that we have around, does it work? I'll give you a quick example. If you look at a Tesla roof, very cool, typical Tesla roof costs a typical home to put a Tesla roof on. It's about $125,000. You get about 30% of that back from the government now. And your payback period, in theory, is about 15 to 20 years, something like that. The problem is if you take that 75 grand that you would have spent and put it in the market and earn 5%, your payback period is never. And so there is, I think, just still some underlying challenges. In the case of the electrification, I think there's good advantages there. I think that there's going to be investments around that. And so to answer your question, how are we doing it? We're hoping that Tesla blows up when they report tomorrow, and then we can make an investment decision at that time. We're not saying we're going to buy or sell or do anything, but you have to be valuation sensitive is my point to that around some of these big themes.
Gotcha. Okay, the theme of this conversation is going long, so let's put you on the spot again for some more predictions. Yelena, you're an economist. Everyone's asking right now, what are the chances that we are going to have a recession? And if so, what flavor of recession?
Right, yes, because recessions are not all alike. And as we focus this panel more towards the young investor, and panelists from the previous sessions have mentioned, most young people were born into a period of very low inflation, very long business cycles, and so recessions are actually very different from one another. So the one we're expecting in our forecast is a mild recession, a Fed-induced recession. That means they're hammering demand to bring it down to the level of supply in a supply-constrained world. So when the Fed brings us into a recession like that, it's easier for them to get us out of a recession on the other side of it once they've seen inflation come down closer to their 2% target. So the timing is quite tricky. We do have it in for this year, but timing that has been very tricky over the last few quarters because consumers and businesses have been so resilient, have really been pushing through all of those downward indicators and still hiring, still spending, but we are seeing credit card usage go up. We are seeing those high interest rates really impacting, for example, the housing market, and so that mild recession is expected this year, but we could be surprised.
All right, Michael, I think I'm going to bring you into this because audience members also want to know how you are investing, given what the Fed is doing and what you see there.
Yeah, I mean, just to frame maybe first our outlook, we see this year as really two phases. And you know, markets felt pretty good the last couple of weeks or so. We think volatility will continue. It's who knows exactly what the messaging will be at the end of the month from the Fed, but there's a chance of some volatility. Maybe we won't quite get the happy Fed that everybody's now anticipating. In any event, the way we think about it is we see essentially 2 quarter points from them, maybe a recession, maybe not, sort of zero growth. As it relates to investing then, we have talked a lot about the idea of making sure people, if they haven't been invested in fixed income, moving back into that, it's really a great opportunity relative to sort of recent periods. In any event, more broadly, with this volatility, near-term focus on quality. In any event, what we think is we'll see the Fed act. We're calling for 50 and then a pause. We think that will help people calm down a little bit. We're calling finding balance in our outlook. And from there, some positive results more in the second half of the year.
By the way, we always carry the Fed live. They're never supposed to be happy. Even when things are going well, they just never seem happy. They always seem to be guarded. Jean, let me ask you, we had some questions about your interest in emerging or small companies versus larger, private versus public. I want to put you on the spot with a prediction that you made on your website that a few months ago that the FANG would outperform the S&P 500. Of course, a lot has changed even in the last few days. Do you stick with that position?
Yeah, I think last year we saw a difference. Obviously, the FANG had a lot of good years. Last year was not a good year. And I think the simple reality is that most of these companies were dependent on them. And I think that even when they're having these layoffs, and we're expecting a pretty subdued tone from Microsoft tonight and from Google next week. Apple's probably going to be probably Apple-like optimistic. But I think all in, if you look at the balance of this year, still feel optimistic about that prediction.
Okay. Elaine, I want to quickly ask you, of all of the factors that you weigh when you make your forecast, what is most worrisome to you right now? Is it the geopolitical instability? Is it the inflation? Is it the challenges on the labor markets?
Yeah, it's a complicated question because it's not just one thing. It's, obviously these supply shocks we've experienced over the last few years have been independent of each other, but they've all accumulated to the point where we're now seeing high inflation from both the demand side and the supply side of the economy, and more specifically the labor market. Labor market shortages have been exacerbated by COVID, but a lot of trends were already in place prior to COVID. We've had a big shortfall in immigration for many years. We had a lot of pulling forward of retirements, especially folks who were not quite in that retirement age. They decided to do that early retirement. And then we have the next generation, especially with Gen Z, it's a much smaller generation. And so these labor market shortages, these are the structural things in the economy that are not going to be solved with monetary policy that create a lot of complication for folks who are trying to think of, where is growth going from here? How are we going to stimulate growth without stimulating too much inflation, but also handling those structural problems that we have in the economy?
Do you think
go on.
Do you think they're solved by, is this a political question around labor? Is it immigration related, or?
I don't have a prescription for this, the silver bullet for it. So immigration is definitely a concern. I myself am an immigrant, so I'm obviously pro-immigration. I'm from Canada. And so, we have the immigration question. That's been a political hot potato for many years now. We have the concern about the aging demographics. And then we also, in the United States, for women's labor force participation on the prime age is about 12 percentage points lower than Canada's. And so that's a concern. What policies do we have in place that encourage women, especially women of color, and then people of color in general? There's a lot of wasted talent that's not being tapped into based on discrimination and bias in the workplace and in the investment environment that's keeping a lot of these folks from participating to their full potential.
Yeah, and of course, the Great Resignation was so much more pronounced with women. I had a conversation with the CEO of KPMG US last week, and we were discussing about how unusual it is now that you have an environment where there are massive layoffs within a lot of the companies that you follow, and yet those same companies are having a terrible time hiring. So they need to both cut and grow at the same time, and they need to do it strategically. There is a question that I think all three of you could answer. Our time is really flying by, but it has to do with international and emerging markets that had underperformed for so long. One of our audience members had asked if you think that there's going to be a rebound. I'd love a quick take from all three of you. So Michael, maybe you first.
Well, I think we're experiencing it, right? It's been a long haul where non-U.S. investments, especially stocks, have sort of lagged here in the U.S. We're seeing a rotation away from that, with especially a little bit with a weaker dollar. Our counsel to clients for sure is to be globally diversified. Our counsel for sure is that there's great investment opportunities offshore. And so we guide people to be allocated. And as I said about bonds earlier, if they're not there, it's a time to take a look and sort of build back out that allocation.
Jean, did you?
I don't have anything to add.
I would agree with that, and I think that when it comes to the international picture, we are going through a much more fragmented world on the other side of COVID. I'm not saying that there is deglobalization, but there's a lot more fragmentation. And so, for example, in Europe, we're seeing that energy crisis really impact them much more than we have here in the U.S. And so pay attention to how some of these trends impact other countries compared to the U.S., because we're not in the synchronized cycle as we were prior to the pandemic. And also, obviously, the supply shocks and the black swans that keep popping up. Again, I'm very humbled in my forecasting, so I won't make predictions there.
Elaine, a quick question. Do you see more layoffs coming? Will they continue to be severe, or do you think we're moderating?
We have a very, in our mild recession baseline scenario, we have a very low peak unemployment rate by the end of this year at about nearing 5.3%. That's quite low when you compare it to the peak unemployment of prior recessions. Again, this is the Fed creating that mild recession, the really quashing demand from the labor side to bring both the job postings down and then also some of those cuts. But we don't have it sector specific, and we do see a recovery happening much quicker.
So Jean, as an investor in the private public markets on very young companies as well as mature ones, I just want to ask you about some of the trends that you are also following. We talk about this fourth industrial revolution, the shift in demographics and how that's affecting industry and how we invest. What are the things that you find most interesting now?
For sure, it's OpenAI. I got a question. I mean, just my nickname is when I was in fourth, fifth grade was the Riddler, so I still love asking questions. I guess the group of question here, who has tried ChatGPT? Okay, get the hands real high. With the hands. Okay. Okay. Wow. Now, by the way, all they've said is there's 1 million users. They haven't updated the number. I think it's probably like hundreds of millions at this point. Second question is, who's done it for more than, gone back a second time and tried it? Maybe a quarter or something like that.
Just for our virtual audience, I want to just say that the majority of people in this room
Majority
raised
of the
their
people
hand,
said,
and about a quarter of the room, and we have an oversubscribed room because we had to bring in extra chairs, said they tried it again.
Yeah, so my point is that at this point it's still a little bit of a carnival trick. It just kind of catches your attention, but ultimately they're going to get it better. They will get it better. Who's really going to get it better is Google's going to likely make some big improvements there. They've hinted that they're going to have something out before the summer. That would include some more real-time information. So to answer your question, what's really exciting, I think what's going around with artificial intelligence and the chat bots are representative of we're getting closer to general intelligence. Just to finish the story, when we get to general intelligence, then things get kind of goofy. I mean, we could get to super intelligence. At that point, it could be the curve, in theory, goes like that, where machines are smarter than humans. So kind of scary, exciting, and there's ways to play that in the private space and companies that are making AI, and there's ways to play it public, whether it's Microsoft or Google.
Let me follow up with that because I don't know this space that well. Are U.S. companies leading this innovation, or are we behind? Or are we
it's
equal?
generally considered China, U.S. My guess is China's ahead just because they're so smart. So I'd probably guess that China's ahead. Hard to say, but my guess is that they've had more resources poured. They get public resources poured, government resources poured into AI, where in the U.S. it's predominantly private.
Do you think that we need more government support?
Absolutely. I mean, this is the new forefront. I mean, it's everything from, I mean, if you get to superintelligence, the way the machine can help build our cities, to help with our healthcare, there's a lot of benefits to it. Again, I'm 52, I'm an old man. I probably won't see superintelligence, but we have to start preparing for it.
Michael, care to weigh in on that?
Yeah, I mean, a couple of things. First, I think to your point, it's really, really early innings. What's so striking about it is you can see the power by trying it out. I was thinking about trying to get this thing to write my weekly note and see what it looks like. You really can do things like that. I haven't done it yet. Okay. You're inspiring me. But to your point, it's really, really early innings. Like the big players aren't yet out to market with capabilities in a way. And so where do we go from here? I think as it relates to how we relate this back to investing, in my mind, a lot of what we're navigating is with these capabilities coming out, how do businesses embrace and take advantage of them? And it's really businesses across the spectrum. So I'm an optimist by my nature. I think there's going to be huge opportunity looking forward.
Mm-hmm. We always get this question when we discuss the future investor, and it's the same question that came up with some of the earlier conversations. We have to ask you about crypto because some people in the audience are asking about the prediction for Bitcoin specifically and crypto in general. So, Michael, is this an asset class that you have fully embraced as Stifel? Are you still looking at it and it's limited?
Yeah, so as I'd say, as it relates to digital currencies generally, and my team's one of those responsible for what I'll call the assessment of risk. So when we look at pattern of investment experience related to digital currencies, it's pretty darn volatile. So the idea of taking something like that and fitting it into an asset allocation, it's pretty hard to do. We know clients are doing it. We'll hear from them how they're engaging. Our guidance, therefore, is usually about percentage of wealth and kind of managing it because the risk side model is pretty heavy. I will say, of course, is sort of the logical thing. When we look behind it, when we look at blockchain and the capabilities related to things like that, that's a whole other thing. Once again, we're looking at how companies are exploring taking advantage of that kind of technology. And let's just say I think it's scores of business opportunities related to blockchain that have nothing to do with digital currency.
Elaine, I want to ask you that, of course, we think of digitization of everything, of industry, of businesses, of becoming more efficient, making us better. But it's really hard when it comes to crypto because it's hard to measure something that hasn't always provided accurate information for someone like an economist to follow. I just would like your thoughts on this as well.
Honestly, we don't do a lot of analysis on crypto. This is something that I personally believe is, like Michael had said, it's a volatile asset class. And so I don't really have much to contribute, I'm sorry, but this is, I agree that the blockchain technology, all these kinds of technologies underneath there are definitely here to stay.
Gene, is this an asset class that you're investing in at Deepwater?
We were. A year ago, we stopped early in 2022.
Well, aren't you smart?
Well, I would say this. I think it was a wash from where we were investing at that point. We haven't gone back.
So we are actually down to our last 4 minutes. So if you have questions, quickly submit them. I always like to end conversations, especially with people in your positions, to look forward. I mean, we had a difficult 2022. And as I opened this event, 23 looks to be challenging as well. So I want to ask you about the things that most concern you and intrigue you in the next 6 to 8 months. So Gene, let's go ahead and start with you.
If I was going to boil it down to one company, I think it's Tesla. I think it's, I mentioned, that this pullback, we're hoping for that. We're not invested at this point, but I think that there's a valuation, near-term valuation question, but I think long-term, this company is really going places. I talked about the return on the renewables. I think they'll get that squared away. And I think they're going to, this price decrease, I think they are absolutely going to crush the competition. Mm-hmm. They're going to be gaining significant market share. It's a pretty emotional story around it, but I'm a big believer long-term in where they're going. And maybe they even get this robot to work. If anybody's going to pull it off, it's going to be Elon. So don't want to put a price target on it.
Even with the distractions going on currently.
He's the master of navigation. And so I think that's still going to be the gift that keeps giving in terms of entertainment of personalities and companies.
Very quick question. I just would be remiss if I didn't ask it. The question just disappeared, but it was asking about, do you find public investments more intriguing versus private? Because some people think that private markets are more efficient right now, greater returns.
I think there's been more disruption in the public markets that creates opportunities more near term. Long term, the private's more exciting just because it's more cutting edge.
Okay. And Yelena, your biggest concerns as you look to forecast in the next 6 to 8 months?
Yeah, I wouldn't say it's as much of a concern as something we're definitely keeping an eye on, which is when the Fed starts to cut rates. As we've seen in our models and as we've seen coming out of this pandemic, we essentially went through a wormhole where the world on the other side is very different than the world we left behind, where now a small Fed cut is going to have a really big impact on the US economy in terms of spurring demand again. So this cut and versus hike scenario is very nonlinear. And so and I see the question about the Fed soft landing. And so the window to the path to soft landing is narrowing, to use Powell's words. I mean, it's still a possibility. And if you consider only a 5.3 unemployment rate a soft landing, then there's your answer. But really, we're paying attention to, the Fed has made it clear they're going to hold rates at that higher point. We expect 3 quarter-point hikes over the next 3 meetings. and then for them to stay there essentially into the end of the year. But what's that going to look like when they even start to hint at rate cuts? What kind of demand is that going to spur? What kind of rally is that going to spur? And as I mentioned, the housing market on the other side of that will be one of the first to recover.
Can you be more specific to this question about the probability of Fed soft landing? Do you want to share your prediction?
Can I pull a Larry Summers and say 33%, 33%, 33%, and just even it out?
Larry is usually more blunt than that. I know from experience being in Boston, but yes, that's absolutely fine. Michael, the final minute belongs to you as far as looking ahead to 6 to 8 months. If you have an investor in your office, what are some of the things that you discuss with them as far as opportunities we should be seeing and biggest concerns?
Yeah, concerns really relate to balance. When we started 22, our theme was finding balance. We had imbalances through the year, which drove inflation up and the Fed higher in terms of rates. And now we're trying to find balance. So I think to Lena's point, to me, the spirit of it is the Fed's got to sort of navigate this, take some further action, but not go too far. And it's going to be, in my view, the risk is how's the market reacting to all that? And do they go too far? As I alluded to earlier, though, as it relates to opportunities looking forward, I said this in another meeting a week ago, it's a great time to be investing. Fixed income is super attractive, non-US is super attractive. When we look bottom up, valuation-wise, lots of great opportunities. So when we look out to the second half of the year, we're pretty optimistic.
All right, Michael, Yelena, Jean, thank you for a fascinating conversation. Thank you. I think we needed another hour with them, and that closes our program. Thank you for being the most amazing audience. I want to thank all of our speakers and moderators for these fascinating conversations. Thank you to our U.S. presenting sponsor, Invesco QQQ, for making this gathering possible. If you'd like more information from our sponsor, just visit the resources tab on the event website. And to watch any part of this event again, and I think you will want to do that, just return to BloombergLive.com, The Future Investor, and you can view it on demand. Again, wonderful questions from all of you. We are so grateful. And for our in-person guests today, please join us for some refreshments, hot cider, and snacks before you head outside. Thank you again for being with us.